right? Sign the honor pledge on Connect and take this poll.
Professor?
Okay, yeah, you can sign it later. So if you have any difficulty and because of the phone and connection,
How can I sign in for the honor pledge? I cannot see it.
You cannot see it. It should be a blackboard. I will show you. I will use share screen. Here, do you see it, Wei Hao?
Yes, I can see it.
Yeah, you should sign honor pledge to prepare for exams. So,
okay, that one.
Okay. So if you cannot do it right now for some reason, like phone connection or anything, you can do it later. But make sure you sign it as soon as you can. Everyone should sign it before the exam. Exam security, academic integrity is a very important thing. So we should make sure everything we can do to have academic integrity, fair evaluation. So that's the most important thing. That's the priority. Okay. All right. So let's get started with the chapter 7. We continue. We started chapter 7, and we will continue today. So let me open first a whiteboard to give you just a warm up of what we have learned in bond valuation. So let's start with a simple example. So we are looking at a bond. So 3-year bond, we are looking at a 3-year bond. And 6% coupon rate. So first, so this is an example. Bonds for coupon rate, and suppose this is an annual coupon bond. So what's the price? So what's the price if the yield to maturity is also 6%? What's the bond price? All right. So do you need to do any calculation to answer this question, or can you answer this question right away? All right. So what's the price of this bond? 3-year annual coupon bonds. So 3-year, yeah, let me see. Let me simplify this. Yeah, so annual coupon bond. So 3-year annual coupon bond, 6% coupon rate. If yield to maturity is also 6%, what's the bond price? If you want to do a calculation using Excel, do it and tell me the answer. But I can answer this question right away without doing any calculation. So if you know the bond price, write it in the chat box. You can either using Excel to do the calculation, or you can use your knowledge to answer this question. Anyone? What's the bond price? So the answer is the bond price is $1,000, the par value. The reason, so you can do the bond price. The bond price is $1,000 par value. you can either calculating par value. If nothing is written, assume that the par value is $1,000. Yeah. So bond price is equal to the par value. Julian, no, the answer is 920 is not the answer. The price is, bond price is $1,000. So this is the answer. Okay, it looks like you have a, so you can either using your Excel, so you use Excel's present value function. You can verify it. So 3-year bond, 6% coupon annual. So let me share this Excel file. So open a new Excel file. So how to calculate the bond price? Use present value. What should be the rate? So yield to maturity is the discount rate. So 6% is the discount rate. So how many periods? This is a 3-year bond. So it's 3 years. What's the payment? So how much is the every year? So this is an annual coupon bond. How much this, if you are the buyer of the bond? No, Julia, your calculation is not correct. So it looks like I saw the payment should be how much? So every year. So this is an annual coupon bond. So bond holders receive 6% of $1,000. So payment is 60. And what's the future value? Future value is 1,000. So, oh, what's happening? Something is wrong here. Should not be this case. Oh, yeah. So yeah, this is entered inaccurately. 1,000. It should be the future value. Yeah. So if you enter 6% interest rate and 3 years of the number of period, and 60 is payment, that's 6% of $1,000. So let me just copy this and then go to the whiteboard. So use Excel's present value function. So you entered this, and Excel told us that this is negative 1,000. So the meaning of this is you pay 1,000 now to buy this bond, and you receive $60, 3 coupons, and then at the end 1,000. So that's why price is 1,000. Yeah, so you should have entered the 6%, 0.06. Yeah, so you instead of 0.6. So 6%, that is 0.06. Okay. So my point is here. So why? So because interest payment 6% and discount rate 6% are the same, the bond price is equal to the par value. So if you, in terms of calculation, equation, it looks easier. So to find the present value is bond price. So bond price, present value should be So bond price should be equal to the present value of all cash flows bondholders will receive. So what kind of cash flow the bondholder receives? 100, oh, not 100, I'm sorry. So what's the, if you pay this bond price and purchase this bond, how much you get after 1 year? 60. $60, right? So 60 is 6% of $1,000. So that's the first coupon. And the second coupon, 60. And at the end of the third year, what you get? 60, the last coupon plus 1,000. And these should be, so these are future money. So these should be discounted. So 1 plus 6% and 1 plus 6%. What should I do here? To the power of 2. Yeah, good job, Jonathan. Thank you. So good, Jonathan, it's your act. So I understand what you are saying. So yeah, it should be, yeah, but it's not. So the equation, I think you're understanding the discounting, but your equation is inaccurate. So take a closer look at this. So this equation should be 1 plus 6% discount rate to the power of 3. The point is, so what I'm trying to say is, so this is, without doing any calculation, I can tell this is 1,000. Why is that? Because interest payment is 6%, and the discount rate is also 6%. So that's why bond price and the par value are the same. So what I'm trying to say is, so I'm using this whiteboard, I'm trying to explain this premium bond and discount bond concept. So to explain this, let me make another example. So what if the market interest rate decreases and the yield to maturity of this bond becomes 5%. What's going to happen to this bond price? The bond price will, interest rates go down, what's going to happen to the present value? When discount rate goes down, present value goes up. Yeah. So when rates go down, this 6% coupon weighing bond price will go up because the market rate is now 5%, but this bond is paying 6% interest because coupon rate does not change, but yield goes up and down, so bond price fluctuates. So this bond price was 1,000, trading at the par value, but when market rates go down, this becomes a premium bond. So this bond becomes a premium bond. So you just copy. So this bond, you enter 5% instead of 6%, you will get a bond price higher than 1,000. So let me share an Excel file. Share the Excel file. Yeah, so here, so you see the bond price was 1,000. So let me just copy this and then change it. And in the second cell, we use 5% instead of 6%. You see bond price becomes above 1,000, $1,027.26. Why? Because it went down, bond price went up. So this becomes a premium bond. Because yield to maturity is less than the coupon rate. So market coupon rate is higher than the market rate. And this bond is being trading at par because yield to maturity and the coupon rate are the same. So what if yield goes up to 7%? So what do you think? What's gonna happen? So let me just copy this. Yeah, so when yield goes up, present value goes down. So this bond price will be lower than $1,000. So let me just change this to change. So yield goes up to 7%. And then this becomes, let me just copy this and change it. This becomes a discount bond. This becomes a discount bond because coupon rate is lower than yield. So this is a dynamic of, and relate this to this whiteboard. Let's read the formula in the whiteboard. Here. So this becomes, so when coupon payment is 60, 60, 60, 60. So this part doesn't change. Coupon rate and par value don't change. But when rates go up to 7%, oh, discounting more, and then present value will be lower than 1,000. Similarly, when rates go down, that means yield discount rate becomes 5%. So lower discount rate, that means present value will be greater than 1,000. So premium bond, discounted bond. So bond prices fluctuate. Why? Discount rate, yield changes, but coupon rate is fixed, right? Any questions? So you should be able to do all these calculations correctly. The exam is on October 14th. We have class and Wednesday's class. So these two classes are remaining. And then Monday next week, that's a holiday. And then Wednesday next week, that's the exam day. So this, again, you need to practice and you need to spend enough time to study. Otherwise, this chapter will be quite difficult. And to make sure you meet all the, you check the Connect website for due dates, for the homework, and don't, so fully utilize the unlimited attempts. And don't lose any points, late. Yes, the exam will be on Connect, using Connect. So it's similar to the setting up we are using quiz, but there will be, so it will be longer. You're gonna use 75 minutes. So it will be during the class time, yes. So exam will be in class, during the class time. All right, so let's go back to the PowerPoint slide. So based on this explanation, everything, all the calculations should be straightforward. So valuing a discount bond with annual coupon. So consider a bond with a coupon rate of 10%, coupon paid annually, par 1,000, 5 years until maturity. If yield is 11%, oh, market rate is higher, 11% than the coupon rate. Then this bond is not as attractive as others. So markets are applying 11% discount rate, but this bond is paying only 10% coupon. So this is a discount bond. So without doing any calculation, you should know that, oh, my answer should be less than $1,000. If not, something is wrong in my calculation. So you can use either this equation, financial calculator, or Excel. So here, if you click this Excel file, you can open this. So open this. So I already made an Excel file for you. So this is a discount bond price, $917.56. But my recommendation is don't look at my answer and use your own, so build your own Excel spreadsheet to make sure you can do this calculation during the exam without my help. So, and then you do it, solve it, make it on your own, and find the bond price do the bond price calculation and compare your answer with mine. So that's my strong recommendation. If you don't do it, you're gonna regret during the exam. So the time for those who practiced enough and understand what's going on clearly, you should have enough time. You will have enough time. But if you didn't practice enough, and if you need to start thinking, oh, what should I do? Which page I should go? And then the clock will be ticking and you will find, oh, I don't have enough time. So don't make that happen. So you should be an expert in this bond valuation before you sit to take the exam. So practice, practice, practice. But good news is after doing the practice, you will be okay. So you should be familiar with using Excel. And if you need any help in this, stay after the class or stop by during my office hours on Wednesday to get help. All right? So let's move forward. So let me share the PowerPoint slide. So this should be, you should be familiar with this kind of calculation. The next slide shows a similar calculation with premium bond. So 10% annual coupon, face value 1,000, 20 years until maturity. Yield to maturity is 8%. So yield is market rate is 8%, but this bond is paying 10% coupon. So this is a premium bond. So you should be able to do the calculation using either Excel or formula or financial calculator. You should be able to find this price. All right. Okay. Yes, in the exam, you definitely need to use Excel. Oh, financial calculator, you can use a financial calculator as well. So if you prefer. So if I give you an answer like so you can either, if I ask you to do this bond price or yield calculation, you can use either Excel or a financial calculator to find the answer. Yeah. So either is fine. But if I'm asking you an Excel-based question using Connect Excel, you should be using Excel. So there, I may ask you an Excel-based question built into Connect as you did in the homework assignment. Then you should follow the Excel rule there. Yeah, so you should know how to do the Excel calculation as well, right? Okay, let's go back to the slide. So this is a graphical illustration of the relationship between price and yield. So why? What's the relationship between bond price and yield? We already learned it, right? So yield is the discount rate. So when yield goes up, the discount rate go up. Bond price is present value. Present value goes down. So that means yield and bond price has an inverse relationship. So yield goes up, bond price goes down. So inverse relationship. So when yield to maturity is equal to the coupon rate of the bond, that means the bond price is equal to the par value. When yield is higher, that means coupon rate is lower, then that's a discount bond, meaning that bond price is lower than the par value because coupon rate is not high enough. So investor, compared to the yield, so investors will not be willing to pay the par value, so there should be a discount. Similarly, if coupon rate is higher than yield, which is the market rate, which is the discount rate, this bond is attractive, so investors would be willing to pay more than the par. So bond price will be higher than the par, meaning that this bond is a premium bond. So you should have a clear understanding of this premium bond, discount bond, the relationship with which one is bigger, yield or coupon rate, and you should be able to understand this concept as well as you should be able to calculate the bond valuation. Any questions so far? No? Then we are ready to move on. So again, what's behind the Excel calculation, financial calculators calculation? So this is the equation. So this is annuity present value. This is the present value of the par value. So the total is bond price. And we already did a lot of semi-annual bond valuation calculation last week. So let's just do a quick review. So bonds usually in the real world make semi-annual coupon payment, but the quoted rate, coupon rate, and yield to maturity are annual rates. So when you're solving a semi-annual coupon paying bond problem, you should be able to know how to adjust those numbers. So what's the price of a semi-annual coupon bond with a 14% coupon rate, 7 years until maturity, and 16% yield to maturity? So which number you should enter to calculate this bond price? So 1,000 is a par value, but what's the payment? So payment, what number you should use to calculate the payment? $70, not $140, because the payment should be $70. Why? Payment is based on the coupon rate. So coupon rate is 14%. So that means $140. 14% of 1,000 is $140. But by definition, that $140 is annual coupon. But this bond paid semi-annual coupon. So every 6 months, bondholders receive the half of 140, which is 70. So that's why we enter 70 as the payment in financial calculator or in Excel. And what's the number of period It should not be 7. 7 years until remaining time until maturity is 7 years. But again, how many semi-annual payments during this 7-year period? 14 times. So that's why N is 14. And what should be the discount rate? Discount rate is yield. Discount rate is related to yield, 16%, but again, it's semi-annual. So 60% rate is 8%. So future value 1,000, you compute using financial calculator or Excel, you get $917.56. Oh, this is a discount bond. Does it make sense? Yeah. Coupon rate is 14%, but market rate is higher, 16%. So this is a discount. Any questions so far? No? Okay, good. And this slide and the next one explains the concept, explain the risk bondholders take. So if you are an investor in the bond market, so you buy a bond, you are subject to 2 types of risk. One is interest rate risk, and the other is, one is price risk, and the other is reinvestment risk. So price risk means that when market rates go up, bond price goes down. So going back to the numerical example I presented to you, suppose you paid $1,000 for a bond because the bond was trading at a par because the coupon rate and yield were the same at 6%. But after you purchase the bond, rates go up, that means bond price drops. Then you lose your investment loses value. Bond price goes down when interest rate go up. So that's the price risk. So price risk is a part of interest rate risk bonds have. So change in price due to change in interest rates. So when rates go up, bond prices go down. And so all bonds have interest rate risk. And all bond price fluctuates when rates go up and down. But what kind of bonds have more interest rate risk than others? So this price risk is higher when maturity is longer. So you should remember this. So long-term bonds and lower coupon bonds have more interest rate risk than others. So why long-term bonds have more interest rate risk than short-term bonds? Because why bond prices fluctuate when rates go up and down? Because of discounting. So market rate, yield to maturity is the discount rate. So when you look at a long-term bond, there is more time for the discounting affecting the bond value. So that's why long-term bonds have more price risk than short-term bonds. So longer maturity affects interest rate risk. So long-term bonds have more interest rate risk than short-term bonds. Any questions? Similarly, all else equal, if maturity and all others the same, coupon rates also affect interest rate risk. So which one do you think have more interest rate risk? Which one's price fluctuates more when market rates go up and down? All else equal, lower coupon bonds or higher coupon bonds? The answer is lower coupon bonds have more price risk than higher coupon bonds. Why? Lower coupon bonds means, relatively speaking, bond price is more of bond price is derived from the par because coupon is lower. Coupon is just tiny or lower coupon bonds. So more of the bond value is related to the par value, which has the largest, longest maturity. So my suggestion to understand this, the relationship between coupon rate and price risk, I ask you to think of coupon paying bonds as a portfolio of different maturity bonds. So think of each coupon as a zero coupon bond with different maturities. And then lower coupon bonds versus higher coupon bonds. So lower coupon bonds are like a bond portfolio, has longer maturity, principal dominating, but higher coupon bonds, relatively speaking, short-term maturity coupons play a bigger role compared to the long maturity principal. So that's why lower coupon bonds act like a longer term bonds, higher coupon bonds act like a short maturity bonds. So that's why lower coupon bonds have more price risk. Have lower coupon bonds are more vulnerable when interest changes. So that's the reason. So any questions so far? So in short, long-term bonds and lower coupon bonds have more price risk than others. So this is about price risk component of interest rate risk. But if you ask me, is it always a good thing? So it's, if you ask, so when interest market rates go down, bond price go up. So if you ask me, interest rate going down, is it a good thing for bond investors? It's hard to tell because of the other reasons. So when interest rate go down, bond price go up. So in terms of capital gains, it's a good thing for existing bond holders. But if you're a bond investor, if market rates go down, your existing bond holdings value will go up. But down the road, when market rates go down, that means you don't get much interest down the road. So it's not necessarily a very good thing. So that's related to the next slide, reinvestment rate risk. So when market rates go down, bond investors have coupons. They receive coupons and they have more money to invest in the bond market. But those coupons they receive should be reinvested, but market rates go down. Those coupons will be reinvested at a lower rate. So that's this reinvestment rate risk mentioned in this slide. So reinvestment rate risk means uncertainty concerning rates at which cash flows like a maturing principal repayment and coupon payments can be reinvested. So short-term bonds have more reinvestment risk than long-term bonds because short-term bonds have principal maturing only, but long-term bonds have lower reinvestment risk because long-term bonds have already the interest payment, coupon payment is fixed. Higher coupon bonds have more reinvestment risk than low coupon rate bonds because high coupon rate bonds have a lot of coupons received, so those should be reinvested. Right? Any questions so far? This reinvestment risk is more of an advanced concept. So in this intro class, I recommend you focus on this price risk component. So narrowly speaking, if you just hear interest rate risk, most people talk about this price risk. When rates go up, price go down. When rates go down, bond price go up. usually people mean by interest rate risk. When people talk about interest rate risk, they usually talk about this price risk, narrowly speaking. But in more advanced class topics as a whole, like how to manage the risk of bond portfolio using more advanced concepts like duration concepts in advanced finance courses, this reinvestment risk as a whole. So my point is the next slide, it is reinvestment risk is related to more advanced concept. Down the road, the finance and accounting students will take in investment class and other courses. And the main focus in this intro class should be the price risk component of interest rate risk. Any questions? No? Okay, let's move on then. So this is a graphical, this figure is a graphical illustration of the impact of maturity on interest rate risk. So as I mentioned before, when rates go up, bond price go down. So inverse relationships. All bonds have this inverse relationship. But compare this long-term bond, 30-year bond with 1-year bond. So which one's price is changing a lot more severely when rates go up and down? This 30-year bond, illustrated by this using this pink line. When rates go up and down, this 30-year bond, the price changes a lot. But what about 1-year bond? Changes a little bit, but tiny change, because this bond matures within 1 year. So the impact of discounting is not huge during this 1-year period. But for 30-year period, the impact of the changing rate, discount rate is huge. Any questions? And the next slide is showing you how to do the yield to maturity calculation. So yield to maturity is the discount rate. So finding yield to maturity in terms of calculation, it's the same. When you use, either you use a financial calculator or Excel function, make sure you enter the correct numbers. But especially what's most important in yield to maturity calculation is sign convention. So let me take a break. So you let me go back to the whiteboard and clear and start over. So in all of the time value of money calculations, we use 5 keys. So present value, future value, payment, and number of periods, and rate. So entering all those to the calculator, you get you can complete the calculation. So let's just to remind you, use this, relate this, the 5 calculator keys to the bond terms. So present value is related to what? In bond language, is related to bond price. Future value is related to what kind of bond terms? It's related to par. And payment is related to what kind of bond terms? It's related to coupon rates. Of course, you need to make semi-annual adjustment, but it's related to the coupon rate. And which one is related to the number of period? It's related to the remaining time until maturity. It takes So this is related to the remaining time until maturity. And what's related to the rate? So discount rate is related to yield to maturity. All right. So among these, all of these, so this is money, this is money, this is money. And two of them should have the same sign. The other one should have the opposite sign. So from the bond holder's point of view, bond buyer's point of view, the price should be will have what kind of sign? It's a negative sign. You pay this bond price, so cash outflow. And this par value should have which sign? Positive. You receive this par value at the end. And this coupon should have a positive sign or a negative sign. It should be positive. You receive coupon, you receive par value because you pay this bond price now to buy the bond. So why do I emphasize this? If you don't enter this, don't follow this sign convention and you compute yield to maturity, you will get an error message. Your Excel is not a human. So Excel, to make Excel or financial calculator work for you, you should follow the Excel's rule and calculator's sign convention rule because Excel has been programmed. Excel and the financial calculator, your financial calculator are programmed to follow this sign convention. So if you don't follow it, you will get an error message. So don't make error messages happen during the exam. If you need to make this kind of error and learn from that error should happen during at home when you practice using your unlimited number of attempts. So don't make that error happen during your exam. That will have a huge negative impact on your grade. Any questions? All right, let's go back to slides. So we have a main numerical exam. So here yield to maturity calculation with annual coupon. So there is an Excel file. It shows an answer. So again, practice on your own and compare with my answer. And there is also semi-annual coupon problem. So here is a yield to maturity is 8%, but I give you 1 minute. So without looking at my answer, using this and build an Excel file or use your financial calculator to do the calculation. So when you work on this calculation, I will take attendance, okay, using screenshot. I'll give you 1 minute. So do the semi-annual coupon bond yield to maturity calculation while I take attendance. So I took the first screenshot and the second screenshot. And I also copy the checkbox as a record just in case we need it later. Okay, hold on. So yeah, I will show you the question. Yeah, here is the question. All right. So does anyone need an explanation on this semi-annual yield to maturity calculation? So raise your hand or write something on the chat box if you need. So I see something on the chat box. All right. Oh, yield to maturity is 8%. So you should be able to find, after you entering this, you get 4% and you multiply it by 2 to get 8%. So, all right. All right, I will show you. So if you click the Excel file, you can get the answer. Okay. Yeah, 4%, yes, semi-annual, yes, 4%, and then multiply by 2, so you get 8%. Looks like you guys figured out what to do, so let's move on. But again, if you haven't done this practice, you must do it at home, and if you should ask questions if you don't have any, if you have a difficulty in doing this yield to maturity and bond price calculation. All right. So this slide, the next slide is about the summary of what we have learned, you have learned so far regarding bond pricing. So bonds, this is called bond pricing theorems. So those theorems tell you that bonds of similar risk and maturity should be priced to provide the same return. So regardless of the coupon rate. So that's the principle. So if riskiness and maturity are similar, the discount rate should be similar. The market should apply the same discount rate. So the pricing we see from the market should be related to this the right discount rate. So bonds with similar risk and maturity, yield should be similar. That's the principle. So if you know the price of one bond, you can estimate. So if you observe the price of one bond, and if you have a similar bond having similar maturity and similar risk, you should be able to price the other bond with similar risk and similar maturity using the comparable bond discount rate. So this is the bond pricing principle, and this is a very useful concept that can be used to price all financial assets. So similarly, I can ask you this bond pricing theorem in a different way. So for example, suppose you are the CFO of a company, new company, and your company has never, your company is currently an all equity company. So that means everything is financed using equity. But you're the CFO and you are considering to use bonds for financing in the future. So add a little bit of that, it will be helpful. Definitely, there is a tax benefit. Interest rate is tax, interest payment is tax deductible, but dividends are not. So, and also bonds are less risky compared to stocks, all else equal, because stockholders are residual claimants, but bondholders are paid before stockholders. So bonds are less risky. So cost of interest rate applied to bonds is lower compared to the required return on stocks. So many good reasons for companies to use bonds for financing. So suppose you are the CFO of a bond, even an all equity companies, CFO you are, and you are considering to issue bonds for the first time. So you need to figure out what kind of coupon rate is right for you for the bond. So what are you going to do? So to prepare to sell bonds, you need to prepare documents and present it to investors, and so that bond should be sold to investors. So how do you prepare the terms, right terms? So how long will be the maturity and what should be the right coupon rate? So my question is, how do you find that information? What should be, for example, what should be the right coupon rate you put in the bond document? So bond pricing theorem tells you. So look at a comparable bond already trading on the market. So if you have a competitor doing similar business, that means similar risk, then find the similar risk bond and similar maturity. So suppose your company decided to sell a 5-year bond, then take a look at the 5-year corporate bond and pick a bond issued by some company similar, having a similar risk as your company's business, and then if a similar company, similar bond is being traded in the market, if you see the bond price, how high is the price, and using the bond, comparable bond price, and calculate the yield, and then set the yield of the comparable bond equal to your bond coupon rate, and then how much will be the price of your bond, because you said the coupon rate is equal to the discount rate market is applying to a similar bond. That means yield and coupon rate are the same. That means your bond will be sold at a par value. But down the road, when market rates changes, market requires higher rate, higher yield, then your bond price will go down for those, but you already sold the bond. So market rate fluctuations will not change the terms of your bond. The coupon rates and par value, maturity will stay the same, but bondholders take the risk of interest rate risk, price rate risk, reinvestment risk. So that's how the bond market works. And bond pricing theorem is telling you that comparable bonds with similar risk and similar maturity should have a similar yield. So that's a very useful principle investors as well as bond issuers are using. And this principle, similar risk assets, financial assets with similar risk and similar characteristics should be priced similarly, should have a similar discount rate. So that's a very important principle in finance. Any questions? All right, and let's move on. The remaining slides about a lot of theories behind the bond valuation and stock valuation. So these slides are telling you the differences between bonds and stocks. So issuing bonds versus issuing stocks, and buying bonds versus buying stocks. So big difference. Bonds are not ownership interest, but stocks are ownership interest. And creditors don't have voting rights, but common stockholders vote. And interest payment is tax deductible, but dividends are not. And if companies skip interest payment, the business is struggling because of COVID, so interest payment, we don't have enough money to make interest payment, that's a big trouble. So creditors, in that case, bondholders, creditors can bring this case to court to take over the company. But if a company misses dividend payment because of business is struggling or COVID case, stockholders cannot bring their case to court. So because dividends are not a liability, but coupon payments and par value payments are liability. So, and if companies financially struggle. So in that case, who would pay the first? So any payment to stockholders should be after a payment to all required payments made to the bondholders. So creditors have priority. So the order of payment is bondholders, so creditors, and preferred stockholders, and common stockholders are the last. So that's why common stockholders are residual claimants. So common stock is the riskiest investment compared to preferred stock and bonds. So this kind of differences you should have a clear understanding. So using slides and the reading assignment of the book, you should be familiar with this. So bond characteristics, how long is the bond terms, and what's the coupon rate, and is there any collateral? Is there a call provision? And is the bond protected by any protective covenants? Though that kind of specifics are written in the contract document, and the name of the document is indenture. So you should be familiar with the terms. So these slides should be supplemented by the reading. And also, I'm gonna post the concept practice questions. So those conceptual questions for your practice, you should use those questions to test your understanding from the reading of the book chapter and the slides. And bond classification, some bonds are secured by collateral, but there are also unsecured bonds. So unsecured long-term bonds with maturity longer than 10 years called debentures. And unsecured bonds with original maturity 10 years or less is called notes. So treasury notes are U.S. Treasury Department borrowing instrument and maturity 10 years or less. So notes versus debenture, difference is in maturity. Both are unsecured. But some bonds, some debts are secured. That means having collateral. And good example of secured debt is mortgage. So when you buy a house and go to a bank and get a mortgage, you borrow using your house as a collateral. So mortgage is an example of a collateralized loan, so secured loan. Similarly, there are also seniorities. Some bonds are paid before others, so that's called the senior bonds. And some bonds are paid after other bondholders. Those bonds are called subordinated bonds. So seniority, senior bonds versus subordinated bonds. So these bond characteristics affect yield. So which bond should have a higher yield, all else equal? In other words, which bond will investors require higher return? So that means higher yield to maturity. Secured debt versus debenture. Definitely yield to maturity on debenture will be higher, all else equal, compared to secured debts, because debentures are riskier. So all else equal, investors will require higher return for this on this riskier investment. So debentures will have a higher yield than, all else equal, than secured debt. Similarly, subordinated debenture, so that versus senior debt. So senior debt will be paid before subordinated debt. So subordinated is the worst. It's subordinated. I will be paid later than others. And debenture, no collateral. So very risky. That means yield will be higher. What about callable bond? So callable bond is also an important concept. So callable bonds compared to other bonds. If nothing is written, assume that no call provision. But there are bonds that have call provision. So suppose you're the CFO of a company and you issue a bond. Let's say your company sells a 6% coupon bond because the market rate that time was 6%. But later, market rates drop to 4%. What would you think? Oh, I should have waited until market rate dropped. If so, I would have issued a 4% coupon bond instead of 6% bond. But if you added a call provision, then you're going to exercise the call provision, call the bond, the 6% bond, and then you issue a new bond at 4% rate if the 6% bond has a call provision. So in other words, call provisions allow the issuing company call the bond back. Of course, at a higher price, that is called the call price, but still, callable bond gives some protection to the issuing company. So that means, would the investors require higher yield on callable bond or a lower yield? Definitely, investors would require a higher yield on callable bonds because it's not good for investors. When rates go down, bond price go up, but the issuing company has a right to buy back the bond at a call price, typically lower than the market price. So that's definitely not good for investors. So bond buyers would require a higher yield as a compensation for this risk. So a callable bond will have a higher yield than other bonds. So at the beginning, coupon rates and yields are set to be similar, but coupon rates are fixed, but yield changes with the market rate. So that makes all the interesting things in the bond market. So another important concept in chapter 6 is ratings. So bond ratings, bonds, corporate bonds and municipal bonds have credit risk. The issuer can go under, default. So when investors buy bonds, they need to pay attention to the credit quality. That means, of course, low credit quality bonds will have higher yield. That means lower price compared to high quality bonds that have higher rating. That means price will be higher. That means yield will be lower. So how do we know which bond has higher credit quality? Rating agencies like Moody's and S&P and Fitch, they give grades to bond. So AAA, highest grade. AA, still high but lower than AAA. So the cutoff is BBB. So BBB is investment. BBB or above is investment grade. But below BBB is a junk bond, high yield bond. So below BBB, yield is very high. So in high yield bond. So low grade bonds below BBB is called the speculative bond, junk bond, high yield bond. Another issue you should be familiar with that government bonds, U.S. Treasuries. Treasuries have 3 types: Treasury bills, maturity 1 year or less, Treasury notes, coupon paying, and maturity 1 to 10 years, and Treasury bonds, original maturity longer than 10 years. So that's U.S. federal government's debt. And these treasuries don't have ratings because so relatively safe, issued by U.S. federal government. And also, you should know there are municipal bonds issued by states and local governments, like state of New York, And another very important aspect of municipal bonds is municipal bonds interest payment is tax exempt at the federal level. So U.S. federal government will not ask you to pay taxes on the interest income received from municipal bonds. So this is tax exempt. So all else equal, municipal bonds will have a lower yield than corporate bonds because of the tax characteristic. So for example, if we are looking at an investor whose tax bracket is 40%, 8% corporate bond, after tax, what's the yield? So 4.8% is the yield after tax for this investor. But municipal bonds don't pay tax at the federal level. So my point is, for this 40% tax rate investor, 80% corporate bond is equivalent to 4.8% municipal bond. Yeah. So, and I can ask you, you should also be able to find equivalent tax rate. So the same question asked in a different way. So at what tax rate 8% corporate bond and 6% municipal bond are equivalent? So you solve for this unknown t, you find 25%. So 25% tax investor, 8% corporate bond, and 6% municipal bonds after tax equivalent. And the remaining slides are about zero coupon bonds and floating rate bonds and bond types. Those are like you can read and understand. There's not much calculation. These are mainly concepts. So you can learn from reading those slides and supplement your reading of those slides by the reading of those chapters. So those remaining concepts are adjusting nominal rate using inflation, expected inflation, to calculate real rate, and how to read the treasury quotes, and also term structure, yield curve. So we will spend some time to do the term structure of interest rates. So this kind of concept. So we are almost done with this bond chapter. So we finished all the calculation, all the concepts you need for bond calculation. So you should practice by doing the homework assignment. And so I gave you enough time for completing those homework assignments. So you complete the chapter 6 and chapter 7 homework assignments following the connect due dates, closely monitor due dates, so don't miss the deadline, and prepare well for the exam, and sign honor pledge if you have not done so already. So we are done with this class. So we will, I'll see you on Wednesday class. So we still have one more class Wednesday. So bring all the questions. So on Wednesday, we will finish this chapter and I will take questions. So if you don't have any questions, we will move on to the next chapter. But the coverage of the exam is chapter 1 through 7, this chapter. So if you don't have any questions, I'll see you Wednesday. If you have any questions, you can stay here, or you can come to my Wednesday office hour. So I will stay a few more minutes so to make sure all questions are answered. So bye.
I got a question, Professor.
Okay, so let me stop share. So yes, okay. You can speak.
So when will be the test? Because I didn't hear.
So say that again.
What will be the test? I didn't hear.
Oh, exam. So the exam.
Yeah, the exam. Yeah.
October 14th.
On the 14th, right?
Yeah, it's written on the syllabus.
Okay.
Yeah.
I mean, there's something I don't like about Connect because if you because I use another formula right for the homework sometimes because I remember for all the classes that I took, and when I put those formula, it doesn't work on Excel. I need to like use the formula that you be explaining, so it's kind of hard because.
So I will let you share screen. So show me an example by your explanation. I'm
Okay.
understanding what kind of issue. So I let you share the screen. So if you are comfortable with sharing it when other students are still here, yeah, I'll let you still share the screen. So show me an example.
I mean, okay. Because
Yeah,
I would type,
let's
I
wait
would
for
type
a
the
minute.
equation.
Uh-huh.
I would type the equation that I had before, so you can see how, like how I did it. Because there was a question that I put this, but it didn't work. Like,
So do you mean, so your question is about so previous homework or the homework you
yeah, previous homework. Yeah,
previous homework?
because I put another formula. Like I put this one, this equation, but I need to use like PB. Yeah.
Okay. Oh, I see.
Okay.
So you enter this kind of equation